what IGNOU is doing in specific. May I request Professor?
I welcome you, dear students of the PG Certificate in Agriculture Policy. In this session, we will be talking about the PG Certificate in Agriculture Policy, one of the course MNR 001, Indian Agriculture Development. The topic of this session is the institutional infrastructure development for the agriculture, public, private and public-private partnership. We have with us Dr. Pramod Kumar. He is the senior scientist in the Division of Agriculture Economics, Indian Agriculture Research Institute, IRI. We welcome you, Dr. Sir.
Starting with the financial institutions, if we look at, there are various sources of agriculture finance, and it can be broadly categorized into two. One is the non-institutional sources, and the other one is the institutional source. Among the non-institutional sources, we have the money lenders, the relatives, the traders, commission agents, and landlords. So these are the non-institutional sources because they are not organized and they are not guided by any rules and regulations. On the other hand, we have the institutional sources, and among institutional sources there are three major institutions, that is the cooperatives, scheduled commercial banks, and the regional rural banks. So over the years, what has happened is, in the initial years just after independence, what we observed was the non-institutional sources were playing a major role in purveying credit, and their magnitude was quite high, to the tune of 90% of the total share of credit was through the non-institutional finance. And over the years, because of the intervention of the government and various policy interventions, what we observe is the institutional sources have become important, and their share is growing over the period. So let us look at the various institutional sources one by one. So coming to the cooperative institutions, we find that the first Cooperative Societies Act was there in the year 1904, and this mainly related to the establishment of primary credit societies, and the non-credit societies were left out of its purview. So as far as this act is concerned, the non-credit societies, those dealing with the marketing, storage and other things, they were left out of the purview of this act. As a result, the Cooperative Societies Act in 1912 came into being, which provided the provision for registration of both credit as well as non-credit societies. So the emergence of both credit and non-credit societies took place, and both of them grew together. But the growth of societies was observed to be uneven across the country. So therefore, Sir Edward McLagan Committee was constituted in the year 1914 to look into the performance of the societies. It was observed that the true cooperative spirit was lacking in the majority of cooperatives societies, and in order to improve the efficiency of the cooperatives, they recommended that the area of operation of cooperatives should be limited. So they should not be allowed to operate in the area as they wish. The area of operation should be defined for each cooperatives, and it should be limited. Then after independence, a committee was set up known as the All India Rural Credit Survey Committee in 1951, and the committee observed that the cooperative credit was unevenly distributed. Again, it was observed that there was uneven distribution of cooperative credit societies. The societies were inadequate, or the credit provided by them was inadequate, and these societies, they lent the credit to the asset-rich farmers or asset-rich people. So and they give a statement that the cooperative has failed in India, but it must succeed. That was the statement given by this committee. Important, very important suggestion. And they in order to improve this situation of the cooperatives, they had given certain recommendations, and one of them was the state partnership in cooperative institutions at all levels. At all levels of the cooperative setup, the state should participate, and the coordination between cooperative credit, marketing and processing should be there, because they are all interlinked, and the efficiency of the cooperative institutions can be improved if these three are interlinked. And they also suggested training of cooperative personnels at all levels. So these were the recommendations in order to improve the efficiency of the cooperative structure. Soon after the independence, Government of India felt that the cooperatives were the only alternative to promote agricultural credit and development of rural areas. So credit received substantial help from the RBI, assistance from state and central government. So just after independence, the cooperatives received a lot of importance and emphasis, and in order to promote these cooperatives, many schemes with the components of subsidies and concessions were routed through these cooperatives. Therefore, cooperative institutions registered a remarkable growth after independence. So because of these initiatives by the government, the cooperative institution took a substantial growth was observed. Let us look at the structure of cooperative credit organization, and what we observe is there are two systems prevailing. One is the short-term and medium-term loan structure, and the other one is the long-term loan structure. Under the short-term and medium-term loan structure, we find there are three-tier system, that is state cooperative banks, that is the apex level. At the state level, we have state cooperative banks in each state. Then district central cooperative banks operate at the district level, and the primary agricultural credit cooperative societies, they operate at the village level. On the other hand, in the long-term loans structure, there is two-tier structure is prevailing: central land development banks at the state level, and the primary land development banks at the taluka level. Let us look at these institutions one by one, because they are very important. Coming to the state cooperative banks, which is the three-tier structure, if you look at this is the apex body, and the members of these state cooperative banks are the DCCBs and the PACs, the primary agricultural credit cooperative societies. And the state cooperative banks, they serve as a link between the RBI and the PACs, primary agricultural credit cooperative societies. And the functions, if you look at the functions of the state cooperative banks, they help state government in formulating development plans with respect to cooperative institutions. So they help in formulating the development plans, coordinate the policies of the government, cooperatives with the government, formulate and implement credit policies regarding cooperative development in the state, act as bankers bank to the DCCPs. So they act as bankers bank. Whenever the DCCPs, they want some funds, they approach the state cooperative banks, and they get the same. They also supervise, control and guide activities of the DCCPs, grant subsidies to the DCCPs for the smooth functioning of the cooperatives, and perform normal banking operations. So they also undertake the normal banking operations, that is the savings, deposits and other banking operation as the normal banks they do. So state cooperative banks also do the normal banking operations apart from these activities. Coming to the district central cooperative banks, they serve as a link between the state cooperative banks and the primary agricultural credit cooperative societies, and the area of operation of these is either the taluka or the district. Members are individuals, they could be the individual persons. The societies working in the area, they become the members of the DCCPs. The functions are to supervise and inspect the activities of the primary agricultural credit cooperative societies. They supervise and inspect the activities, guide primary societies and provide leadership to them, undertake non-credit activities like supply of seeds, fertilizers, sugar, kerosene and other consumer goods. So they also undertake non-credit activities, provide requisite funds to the societies under their control. So the societies which are coming under its control, they provide the requisite funds to them and they support them, accept deposits from the member societies as well as from public. So they accept deposits from both member societies as well as from the public. So that is one of the important activities, because the revenue, that is another source of revenue, and resource mobilization. Coming to the primary agricultural credit cooperative societies, under the this is the ultimate institution which is operating at the ground level as far as three-tier structure is concerned, and the area of operation is village. The function is also to borrow adequate and timely funds from DCCPs. So they borrow funds from DCCPs and help members in financial matters. So they provide the finance or credit to the members of the PACs. Attract local savings in the form of share capital and deposit from villagers. So they also attract savings. Supervise the end use of credit. So this is one of the most important activity, because unless this is done, the effective use of credit doesn't take place, as well as, and that as a result affects the repayment of the funds. Distribute fertilizers, insecticides to needy farmers. So they also take up the non-credit activities, and they make available these services to the farmers. Provide machinery on hire basis to the farmers. So this is very important activity, because in a cooperative basis they can provide these services. Otherwise, an individual person, if they have to buy such machinery, that will cost a huge amount, but it can be made available on a share basis. Associate with the programs and plans meant for socio-economic development of the village. Market the farm produce on behalf of the farmers. So many times the PACs, they also collect the produce and they market on the behalf of the members. Provide storage facilities and marketing, finance, etc. They also supply certain consumer goods like rice, wheat, sugar, kerosene, clothes, etc. at fair price. So this is another additional service which the PACs they do. Under the two-tier structure, that is the long-term loan structure, we at the apex level we have the Central Land Development Bank, and the members of these Central Land Development Banks are the branches of CLDPs. So they have a number of branches. So these branches are members of this. The PLDBs, primary land development banks, and the individual entrepreneurs. So the individual entrepreneurs can also become the members of the Central Land Development Banks, and this acts as a link between the NABARD and the state government in long-term bank transactions. So it serves as a link between the NABARD and the state government. Supervises, inspects and guides the PLDBs, one of the important activities to support the primary institutions. Floats debentures for raising necessary funds. Inculcates a spirit and practice of thrift. It provides loans to member banks for various activities like redemption of old debts, improvement, reclamation of development of land, purchase of agriculture machinery, etc. So it also provides loans to the member banks for redemption of old debts, etc. Coming to the lowest level structure under the two-tier structure, that is the primary land development banks, and the area of operation of primary land development banks is the taluka level. The functions are they provide long-term loans to the needy farmers for the development of land, increasing agricultural production and productivity of land, provide loans for minor irrigation, for redemption of old debts, and purchase of land. So these are the purposes for which they provide the long-term loans. Farmers interested in purchasing tractors, machinery, equipments are financed through this. Banks also provide finance for construction of farm structure. The other important activity of PLDBs is to mobilize rural savings. So they also undertake savings. They accept savings from the members. Next, coming to the another structure among the financial institutions is the commercial banks, scheduled commercial banks, and it is observed that over the period just after independence, the private sector banks were they were operating, and they were largely urban oriented and were controlled by few large industrialists. So as far as the commercial banks is concerned, only the private sector banks were operating, and they were largely urban oriented. So they were not operating in the rural areas where the farmers could get the benefit of the credit from the commercial banks, and they were also controlled by the large and a few industrialists. These private sector banks were not equipped to help socioeconomic to achieve the socioeconomic goals of the country. So they were not trying to orient themselves in order to achieve the socioeconomic goals of the country. The credit needs of agriculture, as a result, the credit needs of agriculture, the small scale industries, and weaker sections continued to be ignored. So these areas remained largely ignored by these private sector banks. And it was observed that though agriculture contributed 50% of the total GNP at that time, only 1% of the total net bank credit was advanced by June 1967. So this was a very grave and serious matter, and therefore the private money lenders dominated the agriculture credit scene, and they used to charge the exorbitant rates of interest. So since the private sector banks were not lending to the farmers, it was the money lenders who were ruling the roast. And as a result, the social control was imposed on banks, which also by the government. The government came up with a policy of imposing social control over the banks. That means the banks were asked or to willingly contribute towards the social needs of the country, that is to lend to the farming community, rural areas. But the desired result didn't come forth. As a result, on 19th July 1969, nationalization of banks was took place, and 14 banks were nationalized. And seeing the success of these banks, in 1980 further 6 more banks were nationalized. As a result, 20 banks were nationalized. The objectives of these scheduled commercial banks was, or these nationalization was to remove the control of banking business by few industrialists, since few industrialists were holding the banking sector. So in order to take out the banking sector from the clutches of few industrialists, this nationalization was taken up. Elimination of the use of bank credit for speculative and unproductive purposes. The resources which were mobilized by the private sector banks were used for speculative and unproductive purposes. So in order to remove or to better use these credit, the money which was mobilized by these banking sector, this nationalization was taken up. Expansion of credit to priority areas which was hitherto grossly neglected, such as agriculture and industry. So in order to mobilize the resources towards the priority sector, that is the agriculture and small scale industry, this was done. Encouragement of new class of entrepreneurs, and provision of adequate training as well as reasonable terms of service to the banking staff. This was another important objective with which the nationalization took place. Coming to the next important institution among the commercial banks, among the financial sector, is the regional rural banks. These were established in the year 1975, and the purpose was to have an institutional agency with clear understanding of rural problems and local familiarity which the cooperatives had. So it was the RRBs was a blend of cooperatives and the commercial banks. So it had it was brought in to have a feature of both commercial banks and the cooperatives. The cooperatives, we understand that the rural they have a clear understanding of the rural problems and local familiarity, which and as far as the commercial banks are concerned, the business outlook of commercial banks should be there in the rural RRBs, and this is the blend of these two features was thought to be there in an institution, and the regional rural banks were created. And it was thought that such an institution could better serve the rural community with more dedication, and because of which it was established in the year 1975. Objective with which the RRBs were set up was to develop rural economy, to provide credit to agriculture and allied activities, to encourage village industries, artisans, carpenters and craftsmen. So these were the focused segment of the society to which the RRBs were considered to be working for, to reduce the dependence of weaker sections on money lenders, to help poor financially for their consumption needs. So they were also meant to provide the consumption needs, because consumption need is an important area, because if the credit is provided for consumption purposes, the diversion of loans, that is the production credit or medium term loans or long term loans, would not take place. Otherwise the people or the beneficiaries who take the loans may have a tendency to divert the credit for the purpose from the purpose for which they have taken, and that will ultimately have an effect on the repayment capacity of the loan. So in order to overcome that, the consumption needs were also to be taken care, to make backward and tribal areas economically better by opening new branches. So for opening new branches in such areas which were not catered to by the commercial banks or cooperatives, these institutions they came up. The other set of institution which provides finances to the agriculture sector is the large-sized Adivasi multipurpose cooperative societies, which is commonly termed as LAMPs, and they came up in the year 1971, and they were considered to be a single window system providing all types of loans, that is production, medium-term loans and the long-term loans. They also were intended to provide technical guidance and also help in marketing of the agricultural and forest produce of the members. All tribal people can become the members of this, and these are opened generally in the areas dominated by the tribal population, and the area of operation of these LAMPs is the talukas or blocks. Another very important institution, that is the Farmers Service Societies, they also came up in the year 1971, and they were organized on the lines of cooperatives to provide integrated credit service to the weaker sections of the rural areas, small farmers, marginal farmers, agricultural laborers and rural artisans. So they were to provide credit services to these segment of the society, and they were launched in such areas where the facilities or districts having the provisions of SFDA or MFAL. These programs, the districts where these programs are running or operating, there these FSS were opened, and all those who are eligible for receiving assistance under this SFDA and MFAL programs could be members, and each of these institutions had a jurisdiction of blocks, so they were operating the blocks. The objectives of such institutions is to supply all types of loans to weaker sections, crop loans, medium-term loans and long-term loans, to provide adequate supplies of requisite inputs and technical guidance, to encourage dairy, poultry, fisheries and farm forestry. So these are the activities. If they are promoted, the landless laborers and the rural artisans, they could get benefit of such activities, and they provide non-farm employment opportunities and income opportunities, to mobilize deposits and small savings. So they were also intended to mobilize deposits and small savings. The recent this is a microfinance is a recent institution which has come up, and it is one of the important institutions, and in order to reach the unreached people as far as credit is concerned. And microfinance is a cost-effective and alternative way of extending outreach of the banking system to the rural poor. So where the banking system is unable to reach such segments, there the microfinance is an alternative by which they can reach. There are two models which are mainly prevailing in this in the microfinance segment, that is the SHG bank linkage program, and the other one is the MFI bank linkage model, and it was started in the year 1992 as a pilot project, and the target group for such a scheme or microfinance was the small and marginal farmers, landless agricultural and non-agricultural laborers, artisans and craftsmen. So these are the type of people to whom this microfinance is targeted to. Advantage of microfinance is on-time payment. So the payment under the microfinance scheme, the payment or repayment of the loans is assured, and it also provides or makes available the savings at the doorstep, and credit facilities are also provided at the door of the farmer or the rural poor, and it also alleviates the exploitation. It also helps in exploiting the untapped business potential in the rural areas. So the microfinance has the opportunity, or it provides the opportunity to exploit the untapped business potential in the market in the rural areas. So small businesses or enterprises could be developed through microfinance or self-help groups. Group of people can come together and open or have a small enterprise which they can very successfully run and operate and earn income. Among the higher level institutional financial structure, NABARD is one of the important structure which has come up in the country, and it was set up in the year July 1982 to provide all types of production and investment credit for agricultural and rural development. So this is the purpose with which the NABARD was instituted in the year 1982, And in order to set up NABARD, the three of the divisions of RBI, that is ARDC, ACR and RPCC, they were merged under, and the NABARD was constituted. And the objective of the NABARD with which it came up was to serve as an apex financing agency for the institutions providing investment and production credit. So it serves as the apex level financing agency for all the institutions which are providing production credit as well as the investment credit. To coordinate the rural financial activities, so it also coordinates the rural financial activities of all institutions and maintains liaison between the Government of India, state government and the RBI. So it also liaisons between the state government, central government and the RBI. It also undertakes the monitoring and evaluation of the projects which it refinances. So it's also one of the major projects are also being refinanced by the NABARD directly, and it undertakes the monitoring and evaluation of such projects.
Why agriculture finance is important for the farmers? Why requirement for credit is there?
Yes.
There is any reason specific? So government has created a number of infrastructure for that.
As far as agriculture is concerned, land, labor and capital and management, these are the four factors which are very important, and among them capital is one of the crucial, plays a very crucial role. And after green revolution, the high value use of high value inputs have increased, that is that of high yielding varieties, the fertilizer, chemicals and pesticides, for irrigation also, and mechanization. Because the use of capital in agriculture has increased, or the use of external inputs in agriculture has increased. As a result, this demands capital, use capital, which the farmers they do not have, and they need capital, external capital, in order to buy all these inputs and use it in agriculture to increase the production and productivity. And therefore the need for capital, and this can come up only from these sources, that is institutional and non-institutional sources. But we know that the non-institutional sources, they are charging very high rate of interest, and whereas the non-institutional, therefore the institutional sources need to be created, and that is why the need for these financial such setting of such huge financial infrastructure is needed in the country. And the government has been taking a lot of steps towards this direction to set up financial institutions, and it has been monitoring also over time to time and trying to rectify if there are certain gaps. So that is why these financial institutions are very important. And coming to the next topic, that is the crop insurance. So we move on to the new topic, that is the crop insurance. What is the structure which is prevailing as far as to provide or make available crop insurance to the agriculture sector? So let us look at the importance of crop insurance. We know that the agriculture production is faced with number of risk and uncertainty. So if we look at the type of risk and uncertainty, that is the production uncertainty, price uncertainty, technology uncertainty, and those caused by business and other people. So production uncertainty is nothing but the fluctuation in production, because of which the farmer loses the income, and the price uncertainty is the fluctuation in prices. As a result, when just after harvest, we observe that the prices of the commodities, they fall. As a result, the farmer they do not get required price for the produce, and as a result the income for the farmer falls. Similarly, technological uncertainty and other types of uncertainties are observed in the agriculture sector. So in order to overcome this, there are a number of methods to overcome risk and uncertainty. So the first one is the reserves. So the farmer can have capital reserve, that is through savings. It can have reserves which can help him to overcome certain these kind of adversities. Then second is the hedging, diversification, have enterprise selection, wherein you have combination of enterprises in your basket, wherein few risky and few stable crops could be taken up, so that in order to overcome risk and uncertainty and production practices. Flexibility is another one. producing a stable and dependable income, and insurance. The last one is the insurance. So we will be dealing mainly about the insurance today. Insurance, if we define insurance is a contractual arrangement by which a large uncertain loss is transferred to another individual or agency for a small cost that is known as the premium. So for a small cost or premium, the other agency charges premium, that is what the farmer pays to the insurance agency, and it transfers the risk and uncertainty to the other agency. That is what is the insurance. Come to the features of crop insurance. The farmer pays the premium when he is capable of paying. So the farmer pays the premium when he is capable of paying. In the beginning of the season, crop season, the farmer is capable of paying. At that time he pays the premium amount and receives the indemnity when he needs it most. That is, if he suffers crop loss or enterprise loss, at that time he is able to get the indemnity, and that is the time when he needs it most, because he had used his capital for producing, or that enterprise used inputs and other inputs by which he has consumed the capital base which he was having, and at the end of the season, if he finds that there is a crop loss, at that time he gets indemnity paid by the institution. If you look at the evolution of crop insurance scheme, then it was intended to set up the crop insurance scheme in the year 1942, but because of the paucity of funds, this could not take place. And in 1970, another expert committee on crop insurance was set up to examine and analyze the administrative and financial implications of operating a insurance scheme. In the year 1973, the pilot scheme on crop insurance was taken up, and it was operated by the General Insurance Corporation. And this pilot scheme was operating only in Gujarat, and that too in few selected centers of Gujarat, and for a particular crop, that is cotton, and for hybrid H4 cotton. Later, this program pilot scheme of crop insurance was extended to other states also, and this scheme, pilot insurance scheme, operated till year 1979. Then as a follow-up of this scheme, another scheme was launched, that is the area-based crop insurance scheme, and this was again implemented by GIC on a pilot basis. Indemnity is, under this scheme, indemnity is payable to the farmer borrower if the average yield of the crop in the area is less than the guaranteed yield. If the average area of the yield of the area is less than the guaranteed yield, then the farmer borrower is payable of the indemnity. So only the borrowers were eligible to get insured, and the sum assured is 100% of the crop loan, with a ceiling of with respect to payment of indemnity. There was a ceiling. Maximum of that much amount is payable to a farmer, that is 5,000 in case of dry lands and 10,000 in case of irrigated areas. And this scheme was implemented in 12 states, and it operated up to 1984. From 1979 to 1984, this area-based crop insurance scheme operated, and this was the features where it operated only. Only the borrower farmers were eligible for this scheme. In order to enhance the scope of this insurance program, comprehensive crop insurance scheme was launched in the year 1985, and this scheme was operating in all the states. Beneficiaries were all farmers availing crop loans. So all the farmers who were availing the crop loans were beneficiaries of this scheme. The crops which were eligible to be covered under this crop insurance scheme are rice, wheat, millets, oil seeds, and pulses. So there were specified crops for which this crop insurance scheme was made available to, and the premium was also defined, that is 2% of sum insured for rice, wheat, and millets, and 1% for the oil seeds and pulses. The objectives of the crop insurance scheme was to provide financial support to the farmers in the event of crop failure. So in the event of crop failure, the farmer gets the financial support. To restore the credit eligibility of the farmers, so if the farmer is not insured and he has taken loan from the bank, then for the next season, if he suffers a crop loss, then in the next succeeding season he is not eligible to take another loan because he has not paid the previous loan. So in order to restore the credit eligibility of the farmers, this scheme was launched to support and stimulate production of cereals, pulses and oilseeds. So it was also intended to support and promote production of cereals, pulses and oilseeds, because if a farmer is insured, he uses more of inputs, and he is more confident in taking up risk and uncertainties. As a result, he uses more of inputs and the production is higher. The role of GIC in implementation of the crop insurance scheme is to administer the scheme on behalf of Government of India. So it administers the scheme on behalf of the Government of India, and it receives premium from the financial institutions. So it also receives the premium from the financial institutions. The financial institutions they collect the premium amount from the farmers, and they make it available to the GIC, issues insurance policies, settle claims promptly, and collect and analyze the statistical data. So these were the roles which were assigned to the GIC, and GIC was doing.
Is this crop insurance scheme is available for the borrower farmers only, or all the any other farmers also can take this scheme?
As far as comprehensive crop insurance scheme is concerned, that was made exclusively to the borrower farmers
Only.
Yes, borrower farmers only. But of late we have another set of institution that is which has come up recently, which I'll be talking about, which also makes available the insurance to the non-borrower farmers as well.
Okay.
So looking at the advantages of crop insurance, it stabilizes the farm business during the period of crop failure. So it stabilizes the farm income. The farmer can act much more confidently in farm business, as there is protection against hazards of farming. The necessary payment of premium inculcates a habit of thrift among the farmers. It prevents the farmer approaching non-institutional agencies during the periods of crop failure, because what we have observed earlier was that in the event of crop failure, the farmer needs capital and needs resources, so for which he approaches the non-institutional agencies who are exploiting the farming community. So in order to alleviate the farmers from approaching non-institutional agencies, these crop insurance scheme plays a greater role. It also enhances the use of modern inputs to boost the productivity in agriculture. In high risk areas, crop insurance serves as a catalyst in bringing areas under cultivation. So in high risk areas, the more and more crops area is brought under cultivation, because the farmer is assured that in the event of loss he is going to get paid from the insurance agency. In order to improve the functioning of the CCIS, that is Comprehensive Crop Insurance Scheme, the study group's recommendations are the sum insured per farmer should be limited to 100% of the loan disbursed, as against 50%, which was made available to up to 150% of the sum insured. The farmers were insured, and a limit was also fixed to the tune of rupees 10,000 per hectare. No new crops to be included into the scheme, and coverage of non-loanee farmers need not be considered at the present state. So these were the recommendations in order to improve the efficiency of the comprehensive crop insurance scheme. Now, coming to the limitations of the CCIS, if we observe that only the borrowers of crop loans were eligible for the insurance, which was one of the basic limitations of the comprehensive crop insurance scheme, because large population remains out of the purview of the insurance scheme. Insurance coverage to a large number of farmers across regions helps implementing agencies to spread risk, that is the law of large number, because if the large number of population is insured, the risk to the agency is minimized, because it collects premium from large population, which helps to pool the resources and make it available to the smaller area which suffers from crop loss. Farmers paying same premium and same indemnity is also not scientific, so that was another disadvantage of this scheme. And it covered only specific crops. Few crops were covered under this scheme, and large crops were left unattended by the Insurance Scheme. As a result, National Agricultural Insurance Scheme was launched in the year 1999, which replaced CCIS and tried to overcome all these limitations prevailing in the CCIS, Comprehensive Crop Insurance Scheme. And the objective was to protect the farmers against loss on account of natural calamities, to restore creditworthiness for ensuing season. These were the objective with which the National Agricultural Insurance Scheme with which it was launched. And the features of this NAIS is all farmers, regardless of their landholding or indebtedness, could take the insurance policy and could get the benefit of the insurance scheme. And the coverage of these crops were also enhanced, that is, number of crops were brought into the purview of the insurance scheme. Approach was again the area approach was used, and it also provided subsidy to the tune of 50% to the small and marginal farmers. So thus a scheme provided subsidy to the small and marginal farmers to the tune of 50%. Then we also had a scheme, another scheme that is very important scheme, that is the pilot seed crop insurance scheme, was launched in the year 1999, because we know that the seed production is a very capital intensive enterprise, and the loss has to be insured in order to see that more number of people they come forward to take up seed production and make it available to the farming community. The crops which are covered under this scheme is the breeder, foundation and certified seeds of paddy, wheat, maize, etc. So these crops were covered under this scheme, and the objective is to strengthen the confidence in existing seed breeder and growers. So seed growers, to instill confidence in the seed growers, to provide financial security to seed breeder, grower in failure of seed crop. In the event of failure of seed crops, these financial security need to be provided to the breeder or grower. Following stages are covered under the pilot seed crop insurance scheme, that is the failure of seed crop either in full or part, loss in expected raw seed yield, loss in seed crop after harvest. So after harvest, if there is a loss of seed crop, and loss at seed certification stage. So either of these events, the farmer is insured. Last insurance structure is the rainfall insurance, which was launched by ICICI Lombard in association with World Bank and IFC, and it was launched in Memorandar district of AP, and it was started in the year 2003, and this was limited to crop loans which were given by the KBS, and the insurance is payable if the cumulative rainfall during the period falls below the historical average. The disadvantage of this rainfall insurance is nature of product is complex. Such a product is very complex and cannot be understood by the farmers. So this was one of the basic disadvantages of this rainfall insurance, and it also depended on large rainfall data, which is made available only from the IMD, which has observatories only one in each district. The advantage of this is it gives a scope for public-private partnership in extending insurance service to the farmers. Poor coverage of public insurance policies gives scope for entry of private sector into the insurance sector, offers scope for use of latest technologies, that is the GIS, remote sensing, etc. can be used for insurance.
Thank you, Dr. Kumar. You explain us about the various institutional infrastructure for the agriculture finance, public scheduled commercial banks we have discussed, the cooperative bank we have discussed about, then the microfinance schemes we have discussed, then various insurance system also we have discussed. Thank you very much for coming over here.
Thank
you very much.
Thank you.